Welcome to the Property Pulse podcast. Today we're very excited to introduce Daniel Simone, an expert in property depreciation with over 20 years of experience in residential construction. Daniel brings a wealth of knowledge to the table, offering invaluable advice for property investors and enthusiasts alike. Join us today as we embark on this conversation with Daniel, uncovering the importance of depreciation and its impact and tax benefits on property investment.
Welcome to the Property Pulse podcast, your prime source for Southeast Queensland real estate insights. Understand the latest property data in Queensland to grow your net worth, as Geoff Tomkins interviews industry experts to give you the latest market updates.
Hello everyone and welcome back to another edition of the Property Pulse podcast. I'm Geoff Tomkins, your host and founder of GCT Property, dedicated to helping you navigate the real estate market in Southeast Queensland. Today I'm very excited to introduce you to Daniel Simone from GeoTax, an industry expert with extensive experience in residential construction and property depreciation. Welcome along, Daniel.
Thank you very much, Geoff. I'm excited to get into a bit of a chat with you today and hopefully we can bring some value to the viewers. So thanks for having me.
Oh, you're welcome. Fantastic. I think it's perfect timing coming up to end of financial year and tax time. I think the content we're going to share today is going to be really relevant for property investors. Before we start, I just wanted to add a general disclaimer. The advice that we give today is of general in nature. It does not take into account your specific needs or circumstances into consideration. So you should always look at your own financial position before making any financial decisions. Daniel, can you please explain what depreciation schedules are and why they're very important for property investors?
Yeah, awesome. So with the depreciation schedule, so essentially legislation says that you can depreciate the wear and tear that accumulates on an investment property over time. So the great thing is that the ATO lets you claim against your taxable income as a property investor. So we can break this down into two divisions. So firstly, we got division 40, which is plant and equipment. And then we have division 43, which is capital works. And one of my colleagues, Nathan, he always uses this phrase, which is an easy way to help us remember the difference between these two divisions. So, for example, if you take a house and you flip it upside down, so everything that falls out, like air conditioning, lights, this is our division 40.
Great. That's a great explanation. I've never heard it explained that way, but it makes very simple, very easy to understand. So I think that's a great analogy. Okay, so how often, Daniel, would you get a depreciation report as a property investor?
Yeah, awesome. So I think the really great thing is about these reports is you only have to get them one time. The reports last for 40 years from when the house was complete. And that's only a one-time report. So that's what's really good about this report. It's not something you have to go back and get every single year.
And can you please explain what are some of the key benefits to having a depreciation schedule for property investors, especially in terms of, minimizing the tax that we pay as property investors?
Yeah, awesome. So I think what's really great about having a depreciation schedule is it helps you reduce your tax that you may need to pay, but also it can help enhance your cash flow as a property investor, right? So we all know as a property investor, having that extra cash flow, that's not only going to allow you to reduce your taxable income, but also have some more disposable income to potentially help you buy your next investment property.
Yeah, I think that's some fantastic reasons. And when I do cash flow forecasts for clients, we always take into account the depreciation because it really can make a difference in the cash flow, especially on obviously newer type properties.
Yeah,
makes a massive difference. So it's one of the side benefits again of property investing. I'd never suggest it's the primary reason, but I think it's just an added benefit that we're one of the few countries in the world that are treated pretty well as property investors in terms of tax deductions, which is fantastic.
I think so. Yes.
Okay, so you briefly touched on the two types of depreciation, a great analogy there. Can you explain a bit more in detail about the two types of depreciation that we can claim, Daniel, please?
Yeah, perfect. So the two methods of depreciation is the diminishing value, which allows you to claim at an accelerated rate, and also the prime cost, which provides a more steady tax deduction. So say, for example, with a brand new property, it's going to allow to claim a higher depreciation amount in the first few years due to the lifespan of the plant and equipment. which depreciates at a much higher rate due to the lower effective lifespan, as opposed to the capital works, which is a flat rate over the 40-year period.
Thanks, Daniel. So are there any changes or updates in the tax laws or regulations that you're aware of that property investors should be aware of in regarding depreciation schedules and changes potentially coming?
Yeah, perfect. So the real main one with the legislation change was the one done on May in 2017. So where the ATO stated that plant and equipment items within the residential properties must be brand new from the tenants to claim. Okay, so this means that an existing plant and equipment assessed on the property, they're not eligible to claim if you have lived in the property or purchase the property secondhand. So I think that last part there is definitely very important. However, unless you have incurred the cost or installed any assets brand new, for example, like an air conditioner, since the new rule change came into play. So that's,
Okay.
especially with buying those secondhand properties, this particular rule is one that sort of, it's been out for a while now, but for new and first-time investors, definitely something to consider.
Yeah, I speak to a lot of investors on a regular basis, and a lot of investors aren't aware, especially first-time investors, of the depreciation that you claim on the fixtures and fittings for new property only.
Yes.
Even if the property's a year old or been lived in or owned by someone else, you lose all those benefits, which can obviously affect the cash flow of the property. So quite an important one there.
Sure.
Thanks for clarifying that, Daniel.
Yeah.
Okay, so are there any particular strategies or tips that you'd recommend for property investors to maximise the tax depreciation claims and depreciation?
Yeah, no, really, really good question. Actually, really good question. So a great way to increase your depreciation is to, renovate your property, or if you're looking to buy or build brand new. So the new and higher the construction cost, the more depreciation that you will be eligible to claim. So, for a new build, having a quantity surveyor to be able to assess the individual assets and apportion a greater allocation to plant and equipment, which is our Division 40, as opposed to the capital works at Division 43, that will make sure that the investor is receiving a higher depreciation possible for the first few years. And it's critical to maximize this in your claims.
Great, and I think that's a really important one to maximise, because when we own investment properties, I've been a long-term property investor. It's the first few years of holding that property where the cash flow is really tight, because eventually, the rents will increase over time, and that cash flow shortfall isn't as critical. But the first few years, when we're really looking to minimise the outgoings that we're personally putting into the property, every claim tax deduction we can help make is really helpful to keep the property under control in terms of cash flow.
And that's why with the new properties and the renovations, the plant and equipment, the Division 40 stuff, that we can, do that a lot, depreciate that higher in the first few years. So it's exactly right. Exactly right.
So just to clarify, you touched on a really good point there about if you're adding, new equipment to an existing property.
Yep.
So if you put a new air conditioner or light fittings in, so you don't have to get a new depreciation report. Is that correct?
No, you don't. So you can get that report updated and just add that straight in there. So it's super easy. We can update the report. So it's very easy. So any sort of renovations that are done or anything that's sort of added, like you said, new air conditioner, let us know, and we can just simply add that to the report.
Fantastic, really helpful, Daniel. Now, I know your company is quite a large company, and something I found out recently was you help clients with insurance, building and landlord's insurance. So please share your details on how that all works. Landlord's insurance, especially for first-time investors, aren't aware of landlord's insurance. So can you just explain on the detail about that?
Yeah, definitely, and you're definitely right, Geoff. I mean, this is definitely a sort of a new thing for the Duo Tax company with the insurance. Probably been a good close to 12 months or so now. But I think where this sort of came from was wanting to make sure that we continue to add value to the clients. And sort of making sure that we always lead with the service first. And I think, one thing with insurance, it's something that we wanted to make sure that we find the client the best product that they can actually sort of receive in that insurance space, and then have a place for them to be able to talk to, and not just sort of jump online and click a few buttons. We want to be very personal with the client. We want to understand, what their intentions are for their property, what their goals are as well too. So, when our team goes and finds them the right sort of insurance, then we definitely get to know a lot about them and their journey. And so the main things we sort of do is just sticking into that sort of property space and helping out investors with their landlord and their building and landlord insurance. So that's sort of the general consensus about what we're doing with the insurance side of things.
Fantastic. Now, can you just explain a little bit more about, for new investors to the market, the landlord's insurance, what's it, the purpose of that, and how that all sort of works? Because that's really important that a lot of first-time investors aren't aware of landlord's insurance.
Yeah, perfect. So, I mean, I think in a general sort of term, taking it back a step with the building sort of insurance, everyone's sort of generally familiar with having their building sort of insured. If something happens to the building, let's talk a worst case scenario, if it was to burn down, then we obviously have sort of, insurance in place for that. But in relation to the landlord, I mean, that is where your income actually comes from, right? Is the landlord, is the tenant actually paying their weekly rent, right? So if something was to happen to the landlord where they don't pay their rent, or something was to happen where you can't actually have tenants in there for certain reason, that is essentially what landlord insurance is. It's protecting you as the owner of that property and as the investor, that if the landlord wasn't to pay for whatever reason that is, then you're still able to make sure that you have some sort of fallback period, some sort of fallback to be able to make sure that your income from that property is protected.
Yeah, great explanation. Thank you for that. I've been a property investor for over 30 years and always had landlord's insurance, and I think it's essential. I wouldn't recommend anyone invest in real estate without having landlord's insurance for the minimal cost of it, really, over a year period. The return or the safety factor is huge, so.
Well, that's exactly right. Exactly what you said, for the minimal cost and for the peace of mind, I think that we can have with it. I think that's really what all insurance is sort of about, right? It's a bit of peace of mind and a little bit of protection for us. Yeah, for sure.
Okay, great. So can you just explain, Daniel, if it's a brand new property or an existing property, do you need to physically inspect the property to do the depreciation report, or can you do the report based on the fixtures and fittings in the contract?
Yeah, so it's actually a really great question, right? And to be honest, we can actually do both methods. It depends on what the client is able to provide us. If we do have all the appropriate information, at the end of the day, Geoff, we have all options available to us. And the most important thing is to really maximize the depreciation report. So if we can do that off the documents provided, then great. If we feel like we can't and we need to inspect the property, then that will happen as well too. So we have all options available to us. And at the end of the day, it's making sure that we can maximize the report. Whichever way we need to do that, that's the way we'll go about it.
Perfect. I think that's the most important point you mentioned about the clients having a choice on that, and they can do either or. So that's really good. Now, I'd just like to thank you. Really appreciate your time that you spent with us, Daniel. Your insights and information today has been very valuable. I know we're coming up to the end of the financial year, tax time, so I recommend anyone that hasn't done a depreciation report, or we do a lot of new construction here at GCD Property. So anyone get in touch with yourselves. I know you're offering a very generous discount to the clients that come through the GCD Property with the form. So thank you for your time today, and also for your generous offer, Daniel.
No dramas at all. I really appreciate you having me, Geoff. It was great to have a chat with you, and I really hope the viewers and the listeners got some value out of today's episode.
Okay, thank you very much, Daniel. Thanks for joining us today. If you've enjoyed the podcast, please share this episode. We'd love you to leave us a review, as it really helps others to find our podcast and benefit from the content that we share. Remember to hit the subscribe button to keep up to date with the latest episodes. And if you'd like to make contact with Daniel or myself, our details will be in the show notes below. Just please remember that we are able to offer our members a discount to the depreciation report through the GeoTax offer. So if you'd like to receive that discount form, please just reach out. And thank you for watching today, and see you on the next episode. Cheers.